I am sitting here today at Vintage Oaks with KC Custom Homes next to Konni Williams.
Hi guys, my name is Connie. I am a mortgage loan specialist for First United Bank with the STX loan team, and we are actually one of KC Custom Homes' preferred lenders. So, hello.
Yes, this is a treat because we get questions all the time on how to go about building from the ground up. Maybe you've already purchased your land, maybe you inherited land and you want to do something with it and you'd like to build a custom home. So Connie is here to answer all of our lending questions in regards to how to build on your own lot.
Cool. So one thing I do want to kind of build on, so what we're going to talk about today is specifically custom construction. So a lot of people will say, oh, I built a house, but they built a house with like D.R. Horton or Lennar or someone like that where the entity has held the construction loan or floated the construction cost, and then they basically purchased that at the end. And that's a very different ballgame than what we're talking about here, where you basically are floating the construction loan and either refinancing or modification into some kind of permanent loan.
Exactly. Yes. And here out at Vintage Oaks, you see it all, but a big portion of it is exactly what Connie mentioned, where you do have to do the whole construction loan process.
Absolutely.
All right. So let's dive into some most commonly asked questions.
How do I apply? Kidding. So the most common thing is, where do I start? Right. So what I tell people on a construction loan, it's fundamentally going to feel the same as getting a purchase loan, right? Or doing a refinance. The loan process itself is really not that different. It's the loan product that we offer. So the one thing I like talking about people is, or the one thing I like setting expectation on is, when I talk construction loans, you have to remember that's a whole different ballgame than talking a purchase loan, because when most banks or entities are underwriting purchase loans or refinances, we're underwriting to Fannie, Freddie, and VA guidelines or FHA guidelines, right? Like, where's a set of rules that we are all underwriting to, and then some of us may have overlays or basically things that we have to take into account that our bank specific puts on. Okay.
Okay.
Construction lending is a whole different ballgame, because normally speaking, the bank or the entity that is originating the loan is putting their own funds up for the loan. Okay. So that's why you see wildly different interest rates, wildly different down payments. It's very different because it's all going to be dependent on the bank that's originating the loan, their risk tolerance, their portfolio strength, everything like that. So my little, asterisk or caveat here is, I'm going to speak a lot about my bank's products and our process, but understand that you may go talk to, ABC Bank down the street. It's a whole different ballgame. Okay. So with that being said, things that I'm commonly asked are like, what's my down payment?
Yes.
So,
and they want to know the minimum down
payment.
Yes.
Yes. Okay. So if you ever talk to me or you have a client talk to me, we talk loan to value. Okay. And the reason I do that is because in a construction world, it's all about the value of the loan in relation to the value of the property. Okay. So that's what loan to value means. So if my LTV requirement or loan to value is 95%, I can lend up to 95% of the value of that property. Okay. If I have equity in that lot, that suffices my 5%. So you don't necessarily need to put 5% down.
Right.
I have to be able to take a step back and say, okay, if I'm building a lot if I bought a lot for $100,000,
yes,
and I am building a house for $500, I can lend up to 95% of $600,000.
Okay.
I use very easy numbers. I don't do math in my head. Now I will tell you, it's all going to usually depend on your loan size. Okay. Most of the time, my bank specific conforming loans, which is that 806 number, as long as we're 806 and lower, you're usually going to be able to get in with as low as 5% down, or basically 95% loan to value. Okay. When you start pushing north of that, so we're talking your $1 million, $1.5 million properties, normally you're going to look at somewhere between 10 and 20%, depending on the product that's being offered, things like that.
Okay.
Normally, I would set expectation, if you are north of $1 million, be prepared for about 15%. Okay. Because we'll probably be able to find someone that can do the 15% down. Now, we get a lot of clients asking about VA loans and VA options and things like that. There are lower down payment options that exist in VA jumbo world. We are still going to have the same underwriting guidelines for a a loan that's going to refi into a conventional is a loan that'll refi into a VA specifically from your loan to value perspective. There are lenders out there that offer a lower down payment knowing that it's going to go to a VA perm though.
So, and just backing up a little bit too, so very first step though, have they already created the plans? Do they already know what their house is going to look like?
Okay, so we can do this one of two ways. How I prefer was have a client come to me after maybe having talked to a builder or two, and I will go ahead and set up a pre-qual. I do a soft pull, so it's not a hard credit pull. I'll structure a loan. So at least that way I can kind of help set expectation of if you can qualify for this or not. I do like someone to have at least chatted with a builder, because what I have realized is a lot of people think they want a $300,000 home and realize they're designing an $800,000 home. So sometimes it's nice to have that conversation so at least expectations have been set. But in general, I like pre-qualifying someone, or at least kind of structuring a loan long before we've really sat down with plans, right? So that's a lot of times, like I said, we work with KC a lot. What they'll do is they'll introduce me to a client. We'll structure a loan long before they've actually sat down and hammered out plans, because if my top end budget's $800,000, I'm not building a 4,500 square foot house.
Exactly. Right? And that's something that they specialize in, is because you walk into their model home, which we'll do a video tour of their model home on another video, but it is stunning. And you're going to fall in love with everything that they have in here. But something they specialize in is, if you love their floating beams, they're going to be able to tell you pretty quickly if it's within your budget. So chatting with a builder like KC Custom Homes, and then going to Konni with that number in mind, seeing to like, hey, can this work together? That would be first step.
Absolutely. Okay. And we work with my commercial side a lot. So for example, let's say you have a client that's getting a land loan, right? Or did a land loan. They can share information with me, and sometimes I can also kind of help set expectations of like, hey, maybe you need to look for a cheaper lot because your budget for your house is going to get whacked in half if you're going to have a $300,000 lot and things like that. So we try to have some of those conversations up front, because I will tell you, nothing is more heartbreaking than someone realizing, like, after they've bought the lot and they're designing the plans, they can't afford to build the house they want. So I would rather have a conversation 2 years in advance to help set expectations and set you up for success than get down this rabbit hole and realize that I got to start back at square one.
Exactly. So chat with you first, then go to a few custom builders, kind of seeing who you match well with, but all the while keeping your original kind of budget in mind.
And it's also too, I've seen a lot is clients say like, this is the payment I want. Okay, well, we can kind of halfway back into that. Like obviously taxes are an estimate, right? But I can halfway back into that. Well, then they go design a house that's way outside of that budget. And sometimes that's a conversation of what is more important to you. Do you want to be house poor? Do you want to have this payment? Or do you want to scale back your 15 offices that you built into this house, right? And so it's one of those two. Sometimes I can help be voice of reason, because it's like, I understand it's really fun to design the dream house, right? And put all the bells and whistles. But when you put the pen to paper, you're like, oh, I don't know if I want to afford that.
Exactly. And then in terms of the timing, so you've met with, people have met with you, they've met with some builders, they've picked them out, they've really narrowed it down. What's the next step after that?
Great question. So normally what you'll do is you'll contract, right? You'll come to us. It'll take about 30 to 35-ish days to close a construction loan. That's all going to be ballpark depending on location, complexity of loan, everything like that. It is not something that's going to happen in 15 days, right? Like construction loans just take a little bit longer, just because there's a lot of moving pieces to them, right? One thing to talk about too is, there's different types of construction loans. Are you doing a one-time close? Are you doing a two-time close? And there's validity in both of them, right? It's going to depend on and we offer both. And I will sit down and have a conversation and say, what makes the most sense for you, right? And I'll explain the good, the bad, the ugly.
That's great.
Because what may work for you may not work for him. Right.
And that's actually a very popular question we get. People do have in their heads they want only a one-time close. So I've had people come to us and they're like, we want a lender who does only a one-time close. But that's awesome that you guys get to do both. Can you just briefly touch on some of the benefits or drawbacks of one-time close versus 2-time close.
Again, caveat here,
Right.
speaking from our bank, right? So the advantage of a one-time close is it's lower risk, meaning that you could lose a job once it's done and you're still going to roll to mod, right? You're still
Okay.
going to modify into your permanent loan.
Mhm.
The downside of that is that when we do a construction loan, we lock that rate up front. That is the rate that you have through construction into your permanent loan.
Yes.
Okay. With both products, you're paying interest only until the property or till the house is done,
Mhm.
right? The difference is, are you modifying that loan into a permanent loan, or are we refinancing it into a Fannie Freddie government type of loan?
Okay.
Or jumbo loan, but in general, it's a conforming loan.
Mhm.
Again, a lot of people like one-time closes because they're less risk.
Yes.
But you will, when you do a 2-time close and you refinance out of a construction loan, you will always have, I don't like the word always, but normally would have cheaper closing costs. Okay.
Yes.
Because a lot of us will give a refund of an origination fee because we want to keep the loan with us. But there also is going to be certain title credits, like an R8 credit, which makes you're not paying for 2 sets of title policies and things like that.
That's why we get a lot who say they want. Yes, exactly.
And in a falling interest rate environment,
Right.
it makes more sense as long as you know you have steady income and things like that, right? It makes more sense to do a 2-time close.
Yes.
Because I'm going to capitalize,
Yes.
right, a lower market where I can refinance. So
Yes.
some lenders will do modifications from like a one-time close and give you a cheaper interest rate.
Right.
Is it technically a one-time close? No, I think a lot of times those are brokerages that kind of keep those in-house,
Okay.
and there's some stuff on the back end that they're doing. I'm speaking specifically from the bank side that what we offer, but honestly, unless a client needs a one-time close in the market I'm in, I'm taking everybody 2-time close.
Yes.
Because it just makes more sense. Just with the clientele that I have.
Yes.
It makes more sense.
Okay. And who would that be? Who's your ideal clientele? Who do you service the most?
I don't really have ideal. I do a lot of VA loans, right? I do a ton of VA loans. And that's the thing. If you're wanting to refi into a VA on the back end, well, I have to refinance you, so it makes more sense for me to do a 2-time close. And basically that origination credit's paying for your refi on the second loan, things like that. So, and because I do a lot of those is why I do a lot of 2-time closes.
Okay.
There are one-time close VAs that exist. We don't offer them. There's some nuances with those. I have some builders that don't mind doing them. I have some builders that will avoid them like the plague. Just depends on your builder. I also do a lot of conforming loans, right? Because even at like a 1.1, 1.2, I can do what we would call a first loan and a second loan. Okay. And that still keeps my payments lower than if I were to take you into jumbo world. Because right now, jumbo world just tends to be more expensive. So because most of my loans that I'm structuring in the back end are conforming, it makes more sense for me to do a 2-time. Now, we have some certain nuances in our underwriting guidelines on a portfolio side for my one-time closes, where I can, like, for example, if someone has a ton of cash, I can do something called asset dissipation, where I basically say, okay, I'm going to take this number and divide it by 120, and this is your income for the next 30 years. Well, now, instead of liquidating those assets where you'd have to pay taxes on them, I can give you credit for them, and you qualify.
Yes.
That's only on a one-time close, though. So it just kind of is the nuances of the product.
Very creative, depending on the client. But that's really awesome that you have options for both.
Absolutely. And I'll tell you, we're not always the cheapest. Right? A lot of times with construction loans, the people that are cheapest, and I'm not going to name credit union names, but the process is not super fun, right? Or they won't let you raise retainage.
Yes.
Okay, so retainage is, state of Texas says that banks are supposed to hold 10%. Most builders require you to waive that.
Okay.
If you won't waive it, you are floating the difference between what a bank funds and what the borrower or the builder needs, right? And it would be a delta of 10% throughout the construction project, and that's a ton of cash, right? And so if there's things that, maybe the cheapest option isn't always best, and working with a lender that can have those conversations and set those expectations is so important, because there's so many more moving pieces to this.
So after you basically lock everything in terms of, they're going with you. We got our builder situated. We it's been the 30 days, like you talked about, for the construction loan to close. Okay, next up, they get started building. Okay. Tell us about the draw process. What's that look like?
Okay, good. Great question. So most builders use an online platform called Built. Okay. So basically what would happen is, I'm going to use Casey's example. So Ryan's one of the brothers. So Ryan would say, I need a $100,000 draw, okay, for foundation. So remember, when we do construction loans, we are funding for work completed, okay? So what we'll do is Ryan would request homeowner, right? Mr. Homeowner will agree, hey, I think the work has been done as well. We'll sign off on it. We as the bank will send inspectors, okay? Now my guys are check the box inspectors. They are not quality inspectors. So my guys say, yep, there's a foundation. They're not going to say, ooh, there's a crack. I'm concerned.
They're like, it exists.
Exactly. It's just there. There is a picture and it's uploaded into the system, right? So once that's done, that money's funded, then you start accruing interest on what's been funded, because that's the biggest confusing part for people to wrap their head around.
Yes.
Construction loans, you do not pay interest until the money has been borrowed from the bank. So I always explain construction loans like a credit card. You have access to the money. You don't pay interest on it until you've actually borrowed that money.
That's such a good way to describe it, because it has taken me a really long time to even wrap my head around it. So that's perfect. I like that.
And that's what I tell people is like, so we require contingencies. Okay. So a contingency is a buffer line item, right? If it's a fixed price contract, 5%. If it's a cost plus, we'd want 10%.
Right.
And the reason we do that is if mama wants to upgrade granite.
Yes.
Or if maybe lumber costs came in higher and things like that, that buffer would get drawn, right? If you don't draw the money, you're not charged for it.
Right.
And the other thing is, the reason you want it on the budget is because you want the appraiser to hit that higher price.
Yes.
So a client requests a draw through an online system called Built. Again, that's with us. Pretty common in construction world. Once that's been done, so Ryan, like for example, in Casey Custom Homes, Ryan's will request the money from the homeowner. The homeowner will approve it, right? Because in the grand scheme of things, it's still your money. Once it's been approved by the homeowner, my guys will go back out and they will make sure that the work's been done, right? My guys are not quality inspectors. They are check the box inspectors. They say, hey, framing's done. They're not going to say, ooh, that 2x4 kind of goes like that. That's not what my guys do. Once that's been done, right, and we funded the draw, you'll start paying interest on those draws. Okay. Now, what I tell people is if we are doing honestly a 1 or a 2 time, specifically a 2 time, when the cabinets are going in, you are calling me. And the reason I do that is cabinets are usually about 60 to 90 days out. I'm going to have a lot better grasp on what is going on in the market than I do potentially 180 days to a year out, right?
Yes.
And so that's when we're having the conversation. What does the second loan look like? How much money have we put down? Are we over budget? Just really setting expectation of what that permanent loan process will look like.
Awesome. And then say cabinets are going in, they're calling you, you're like, okay, we're about 90 days out or so. You have those conversations, and then what does it look like to get to the finish line?
You're either literally done, you sign an all bills paid affidavit, meaning that everybody's been paid, right? Once that's been signed, you're either modifying into your permanent loan or we're refinancing you into your permanent loan. Now, if you're doing a 2 time close, sometimes what we'll do is we'll let you write out an interest-only payment or 2. Let's say rates are falling. Right. Or I have a client selling a house right now. It makes more sense for them to pay an interest-only payment, wait for their house to sell, than it does for them to close on a loan, house sells, then we're putting all the money down and refinancing in 3 months.
Yes.
So we can, that's again, that 2 time makes sense where I can get a little strategic on what that permanent loan is going to look like.
Awesome. Okay, Connie, this has been incredibly informative. Thank you for walking through the entire process for us. Now, if you had one piece of advice to give someone if they are considering, say, building on their own lot or maybe buying a lot out here in Vintage Oaks and getting ready to build, what would you say?
Plan accordingly. Biggest pitfall I see is that people don't have enough cash for a construction loan. Even working with some of the best builders, you tend to go over budget, because you're in the middle of it and you're like, I'm going to do this once, like, hell yeah, let's just upgrade this or let's do that, right? And so you just end up going over budget. And so I tell people, make sure you have cash reserves, right? Like, How many times have you said, oh, I'll just save up for that, but then life happens. The dog breaks a leg. The kid has to go to the hospital. Something happens. So set expectations with yourself is I'm going to need cash through the construction process into the permanent loan. Don't cut yourself short because it's going to bring a lot of stress into an already stressful situation.
That makes a lot of sense. And when you have a great team backing you up, we are all here to help.
Absolutely. So if someone wants to find out more about a construction loan, they can reach out to me at 830-560-6126 or visit us at stxloanteam.com.
Thanks so much, Connie. Y'all be sure to like, subscribe, and stay tuned for our next video.